We just talked about Wall Street's wall of worries, long list of them right now, including the Fitch downgrade. Which one of them do you expect to be having the biggest impact on Wall Street today and this week?
I think it is yields. I think it's Treasury yields, particularly that 10-year that you highlighted. I don't think it's primarily about Fitch, though. I think what you saw out of the Bank of Japan and the loosening of their yield curve controls has been pushing rates up more than the downgrade really has. But when you think about that kind of 4.25 level on the 10-year yield, that's been the peak. We haven't broken above that. Everybody's view in the bond market is that we would see yields lower this year, not higher. If we break above that 4.25, which we kind of got close last week, I think that's something that could spook markets, give you a little bit of a sell-off. We'd be buyers of that weakness, though, if it happens.
So you're adding to our wall of worry right now. You're saying it's yields. I'm looking at the 10-year 4.09. We actually saw the long end of the curve go down a bit after the Fitch downgrade. I know you say the Fitch downgrade is not that meaningful, but it did have some meaningful impact on the bond market. So how does that shape your view of, just very quickly, of fixed income? Are you buyers of the 10-year now at this elevated yield?
So, we've been slightly long duration this year, not much, just about kind of 5% over the benchmark. We have not jumped in and added more at this point. I think we want to see where these yields settle in, given what's going on, not only in Asia, but also with the inflation data that's coming in. We're seeing wheat prices move back up a little bit. We're seeing oil move back up again. I think we want to see a little bit of inflation data. Yeah,
we have seen commodity prices tick up. At the same time, we've seen the dollar tick down. So kind of an inverse reaction there. I also want to talk to you about the Fed. So you sent us some notes. According to the CME right now, there's an 80% chance of a pause of the September meeting just about a month and a half from now. And that's even with voting member Michelle Bowman saying she thinks that we need more hikes. How does that shape your view on the markets in the short term and then in the long term?
Look, we've had a kind of major pullback we did last year. We've come through that. That's typical of Fed rate hike cycles. You see that normally. As you get into Fed pauses, though, these are really good for stocks historically. 13, 15% returns, 20% max rallies. I don't know that we're in that pause yet. I think we could see at least one more rate hike either in September or November, but clearly that's the direction to travel, and it's hard to get big pullbacks in the market when the Fed's on pause historically.
I want to talk to you about, or actually go back to our wall of worry. China's in that wall of worry right now. Morgan Stanley telling investors, pull your money out in case lackluster stimulus measures trigger a retreat. How do you view Chinese equities right now? And what impact do you see a pullout of American investors in China having on the U.S. markets?
Well, they're difficult. I mean, China's really difficult because not only do you have this, you can't really stimulate China unless you stimulate the property market, and they can't stimulate the property market because of some of the debt issues that exist there. So it's a difficult market. We think there's better opportunities elsewhere. And in terms of the United States long term, you're seeing manufacturing construction GDP in the U.S., the highest it's been in 30 years. That's a sign of re-onshoring, production coming back to the United States, and we think that's a big long-term theme for the U.S.